Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And today we have another repeat, third time, very special guest with us for episode 28, Why We're All Fucked, featuring Cube Crusher. Please welcome back to the show, Cube Crusher.
Thanks for that wonderful introduction. It's great to be back again. I think it's been a few months since I was on here, and I think a lot's changed for everyone since the last time that I was on the show here.
All right, well, we'll dive into it here in just a second, but before we do, quick shout out. You know I have to do it. We're trying to go worldwide, even though this is a U.S.-focused and centric show. Shout out to our 17th country. Please welcome listeners in Kenya. Thank you very much for tuning into the show, and thank you to all of our listeners who continue to tune into the show. Eventually, we might try to monetize this thing, and I might throw an ad or two up there. I hope you guys don't mind, but this show is absolutely an expense, but we do it because we love it. It's entertainment. It's education. We don't give advice. There's our disclaimer. Enough of that. Okay, let's bring Q back on, and he actually titled the show. So initially, the title of the show was going to be The State of the Economy featuring Cube Crusher, and we thought that was kind of boring. So I asked him, what should the title be? And this is what we came up with: Why We're All Fucked. So take it away. Where do you want to start?
Well, yeah, I guess we'll start. If people listened last time I was on, they know that I'm a fairly aggressive investor, investing mostly in high growth companies and in some crypto and things like that. And if they've been investing in similar things like that, we are all losing our asses this year so far. And I believe today is Friday, whatever, September something or other,
16,
and
the
market is once again getting crushed again today. And you hear people say all the time that just keep investing, yada yada, bullshit, everything will be all right. And if your time horizon is far enough out, yeah, obviously it's proven that over time, stocks are going to go up. Your investment portfolio will go up over time. But I think that this year it's kind of ended a 10 plus year run that every dip has been bought and everything's been hunky-dory. And the more that you throw in, the more money that you're making. And I think that has suddenly changed. And I'm guessing that a lot of your listeners are out there and they've kind of realized that and they're wondering what the hell is going on.
Well, based on what you just said, they should not, unless their time horizon is long enough, listen to episode 15 titled Fuck the Noise. I think that's the first time we used the F-bomb in a title, because that's pretty much what I tell them to do. Not that we give advice, but, just education and information. But that's pretty much the gist of that episode is just fuck the noise, who cares, keep going. But you're saying this time may be different.
Right. I'm saying that the noise is there for a reason. I'm not an expert in the markets by any means. I'm not an economist, don't claim to be one, but I do try to keep myself fairly educated on the market since I am frequently trading. I don't really frequently trade stocks. I'm frequently trading futures, contracts, and it kind of helps to make it a little more profitable if you know what the hell is going on out there. I do have professionals that I read the things that they put out and try to formulate kind of my own opinion. And thus far this year, the ones that I've been reading pretty closely, it's all been correct. People need to brace themselves for something that could get a lot worse. I think the S&P coming into today was maybe down 17 to 18% year to date, which it is what it is. It's a loss. I think we're roughly, 10% off of the absolute lows for the year that happened back in June. But we'll get into kind of personally what I'm doing investment-wise because of the thoughts that I'm going to share. But I guess the first thing that people have probably noticed, or at least a couple months ago, they noticed the price of gas went way up. It's now gone down for 90-something consecutive days, which is almost unbelievable. But gas, I think, is a good example of something that is happening and it is affecting everybody out there. And eventually, it's going to affect every company that's out there. It actually already is, certain companies to different extents, but that is something most listeners have probably heard of, which is called inflation. You go to the gas pump there for a while. I couldn't fill up my cheap ass car for less than $50. I couldn't imagine having a big ass truck or an SUV. You were looking, at possible, $100+
Is that thing still running, by the way?
Yes,
okay,
it still runs.
I got really excited about when we're going car shopping so we can negotiate the fuck out of the deal.
No, it's still purring like a kid, and it's got a lot of life left in it. Okay. But even people going to the grocery store, you'll notice that your grocery bill has gone way up. And essentially, what inflation is doing is it's more or less, to put it as kindly as possible, it's a tax on the poor. It makes everyday things cost more. And if you're rich, it doesn't really matter if it costs $40 or $80 to fill up your car with gas. But, if you're on the lower end of the income spectrum, it's going to greatly affect you. And eventually, when things start costing more, you're going to have decisions on what to pay for and what not to pay for, what to put on credit, and whatever's happening. But the biggest issue that inflation is causing is our friends over at the Federal Reserve, who most listeners have probably heard of. They're the ones that are hiking rates. I believe they have a meeting next Tuesday or Wednesday, and the expectation is they're going to hike another 75 basis points for short-term interest rates. They are doing that to fight inflation, because inflation is essentially the economy running hot. So the Fed is telling us that, oh shit, things are getting out of control. We gave people way too much cash back during COVID. Interest rates were at zero approximately, I want to say, March of last year. So you're looking at 18 months. We've gone rates from at 0% to, I want to say that the 2 year is right around 3.7% as of today, which has almost reached its high from back in 2007. They've been on a steady decline since then, hence free money, hence everything going up, including the stock market, crypto, housing prices, everything. And I think now is the time that you need to listen to the Fed. They said don't fight the Fed on the way up. When they were handing out money, you knew stocks were going up. They're going to keep going up. Now it's the reverse. Don't fight the Fed on the way down. They've told us that they're going to raise rates. They plan on keeping raising rates, and the reason they're doing that is to fight inflation. They're essentially trying to, I'm not going to use the word crash, we'll say cool down the economy, to slow down things and slow down the increase of cost of things, because people are out there spending so much money that they were handing out for free.
All right. A lot of information. I've been taking some notes as we're going here. One thing, just as sort of a minor point, almost off to a tangent, and of course everybody has an opinion on what's going to happen. This probably was the case before the last hike too, but I was reading something, I think it was actually today, that there's a lot of people supposedly out there, economists, and neither one of us are economists. We just like to play one, or Cube Crusher likes to play one on the podcast. I'm just kind of here for the interview. But they said that a lot of people are expecting 100 basis points, so 1 full percent of a hike as opposed to 75, which isn't, I mean, you could argue whether or not that's materially different, but any thoughts there? Do you think it's going to be another 75? Do you think it's going to be more than that, less than that?
No, I definitely don't think it'll be 100. I think 75 at the high end, and if you look back, they already did, 275 basis point hikes, which are the largest hikes that they've done in several years. I mean, it's pretty unbelievable, and I don't think people are really respecting what's going to happen as a outcome of them hiking rates like that. But I don't foresee 1% hike happening. I think that would be totally absurd, and your stocks, your 401ks would all go down real quick next week if they do hike a full 100 basis points.
Okay. Interesting.
That's just my thoughts on it. I mean, it could end up being less than 75. The reason that recently, last week, no, it was this week, the market went down a whole lot, wasn't it? Last week, the market was running up in anticipation of the CPI print, which is a consumer price index. I don't even know what all is factored into that. I just know that when it got announced this week that it was higher than I think the market thought it was going to come in lower all last week. So I believe in a 4 or 5 day period, the market was up 6%, and then this week it went down 4.5 in one day when it was actually announced because a lot of people were caught off sides and in part of what they call, or I would call, bear market rallies. Anytime this market is going up right now, it's still in a downtrend. I still consider it a bear market, even though there's been some huge rips that have been, 4% in 5 days is quite a ways up. But if you look at the overall trend or a 1 year chart on the Nasdaq or the S&P index, you will see that every time the market rips like that, all we're doing is making lower highs, which eventually lead to lower lows.
A little technical analysis coming in there.
Yeah, I'm not much of a chart guy, but I see
bust
people
out the charts.
that
Got a
follow
YouTube
the
channel
charts.
going.
Yeah, there you go. I'm just saying. Typically, that's what happens. You don't hit all of these lower highs and not end up going lower than what you were, which I believe was 36. What was it? 3660, 3680 on the S&P 500. Was the low back in June. So I would absolutely not be shocked if we go back down there, which is, I don't know, approximately 7 or 8% maybe from where we are right now as of today.
So I don't know if we cover this now or touch on it on the investing side. I always have to try to talk about real estate in some capacity. And you brought up, I'm going to go off on a tangent here for a second. You brought up something that was interesting, and I've heard it before, but it kind of just, I don't know, it really resonated for a second. So the essentially quote unquote tax on the poor, if you will, and we're not trying to poke fun at anybody or put anybody down when we say that. We're just kind of trying to be funny, I guess, but at the same time, like, it is what it is. If you're paycheck to paycheck, or generally blue collar workers and whatnot, even some white collar workers are paycheck to paycheck, for crying out loud, you have to make some difficult choices sometimes. And I was actually thinking about doing a podcast, and this is maybe, I don't know, a month or so, maybe a little bit less ago, about my first eviction. I don't know how much I told you about this, but anyway, I had my problem child, as I like to call it. I have the first house I ever bought. It's kind of crazy, all the issues that we've had with that off and on. I probably told this story on a previous episode about a tenant who passed away and all that kind of stuff, and that was the same house. But anyway, so we had some folks that moved in. They were transfers from basically another property that's managed by this professional property management company, and they had always paid on time, yada, yada, yada. Well, all of a sudden, the wife was out on leave. They just had a child, and they got to the point where they were behind, I believe it was up to like 2.5 months, something like that. And I thought, wow, like, here's, presumably good people. They have a great history. They've always paid on time in the house that they lived in previously. They move into one of my properties. They started off on the right foot, and here we freaking go. And I was going to make a podcast just about my first eviction because, it was, well, we're going to pay by this date, or we're going to pay this much by this date, and we'll have the rest paid in full by that date. And that happened maybe 1 or 2 times, and those dates have come and gone, and literally they paid zero. So it's kind of crazy. And it turns out, the wife was out of work. She wasn't getting paid. She finally got back to work. They got back on their feet. And, we did start eventually. We probably should have done it a lot sooner, but we try to give people the benefit of the doubt. We finally started the eviction process, and, I had to pay the legal fee for that and the eviction filing fee and all that crap. And all of a sudden, it was really weird. This is, I don't know how far down this rabbit hole I want to go. So I love coffee creamer. Like, that's my one non-negotiable in the morning. I have 2 cups of coffee. I have to have my coffee creamer. And it was the first day. I call it the cinnamon shit day, right? So the first day, I put cinnamon in my coffee. People are like, you got to try cinnamon. It's better for you. Don't use the creamer, blah, blah, blah. And I was on the shitter. I was drinking my cinnamon coffee. I log into my PM portal, and lo and behold, they were magically caught up. So they had paid, at that point, I believe it was the two months that they were behind. And then a few days later, they paid the 3rd month, so they were current on that. They reimbursed the eviction filing fee, and then probably within, I'd say, 2 weeks after that, they had paid almost, I don't know why the change, it was like $999.75 or something. Just pay a fucking $1,000. But they paid $1,000 extra to have something on the books, kind of as a good gesture, I guess, going forward, basically as a sign that they're going to continue to pay rent. I don't know where they got the money. I don't know how they got the money. I'm not asking questions. Maybe they were just hoarding it, hoping for the worst. But my point in saying all this, coming full circle, because I've gone way far off with this tangent so far, is that people have to make decisions. And I can almost guarantee you they were buying diapers. They were buying groceries. They were taking care of the new baby. They were doing what they had to do. If they have car payments because they have, the husband needed a vehicle to go to work, presumably, they were making the car payment. But they weren't, crazily, they were not paying their rent at the time. And you would think that's one of the first things that you would pay because you want to have a roof over your head. And maybe that's on us and the PM for being a little bit too lenient initially. But now, once we did that eviction filing and they got current and then some, I think we kind of scared the shit out of them. And they realized, like, oh, these guys aren't fucking around. Like, if we don't pay, we're gone. And I don't want to do that to anybody. But anyway, so tough decisions need to be made in terms of what you pay, what you don't pay. And I guess for some reason that just, I don't know, reminded me of that. And I was going to do that episode. And then thankfully they got caught up and then some. So I didn't do the episode because we did not have to move forward with the eviction. But it was going to be one of those things because I know we always joke around and you tell me, hey, real estate investing is all, rainbows and unicorns, all you real estate people, this, that, and the other thing. And it's like, no, I was actually going to do a podcast on like how sometimes you just get like kicked in the mouth. And, fortunately this time it wasn't all that bad. I still have my teeth, but, it could have been. And I think that there could be, as it relates to today's conversation, there could be more situations like that where people have to make those tough decisions. And what do they pay? I don't know. Do they pay their rent? They're probably going to buy groceries. Do they pay their student loans if they have them? Or, when that gets lifted? Whatever. I don't know. But anyway, so I'm going to pause there and turn it back over to Cube. Any comments on the choosing on what to pay or anything I just said?
Yeah. So it's interesting that you say that. I was actually listening to a podcast, I believe it was yesterday or the day before, when I was out for a run, and it was like a professional fund manager or whatever. Of course, he was hyping up his book or whatever. But one of the companies, one of the stocks that he mentioned, I won't say the name, but it was a financial company that mostly does car loans. And he made the comment that regardless of anything, the first loan that anybody is going to pay off is they are going, or not pay off, make the payment for, is they are going to pay their car loan. He said they will pay their car loan before they make their mortgage payment if there's a choice between the two of them. And I kind of thought to myself hearing that, I was like, I always kind of thought to myself, mortgage, rent, whatever, to have housing would always be the first payment that you make. But he kind of had a point there that if you think about it, I mean, if I get my car taken from me and I can't get to work, well, then I'm fucked. Mm-hmm. I'm not going to make any money.
Yep.
So, that kind of opened my thought or my brain to that idea. And I was like, you know what, that does kind of make sense. And I've never really thought of it that way. But I guess to continue on the housing side of it, one thing, let's see, we'll call this a suggestion. It's not investment advice. I would tell anybody out there if they are looking to buy a house right now to absolutely not fucking do it. The housing market, well, mortgage rates yesterday, the 30-year fixed just went over 6% for the first time in, I believe it was 10 plus years. But that isn't the main reason to not necessarily buy one. But those mortgage rates are going up much, much more quickly than housing prices are falling. I guess kind of one way to look at it would be to say, okay, certain prices of certain items, they can turn and change real fast. It's more like a speedboat. But housing prices, you're looking at, it's more like turning a cruise ship. It's going to take a lot more. It's going to take time before these housing prices start falling down. So I would wait on that before I even thought about purchasing a home. Thankfully, I purchased one about 5 years ago, and I have a very low interest rate because, the interest rate environment right now is not friendly, but you couple that with people not dropping the prices of the houses very quickly, they don't move as fast. Buying a house right now just does not seem like a good idea, at least definitely not one to live in if you don't live in one. Moving houses is probably not a good idea either. Just because, I mean, that's essentially, like I mentioned earlier, the Fed raising these rates, that's what they're telling you. They don't want the housing market to be booming right now. They want it to slow down.
They want it to slow down, though, or they want it to crash? Because let's say you have somebody, I have a friend of mine that comes to mind right now, and she and her husband are thinking about that. Like, they're renting a place right now, and their rent is, I mean, for the area that they live in, it's fairly reasonable. It's not outrageous by any means, but I think she said something like that last time if they weren't going to sign a 1 year lease on their place, that they were going to charge them, I forget, it was like there was a one-time fee, maybe $100 or something, and then it was going to be an additional $75 a month to go month to month or something like that. And so they're thinking about buying a house, and they have some money saved up, and they're thinking about going for it, and they're hemming and hawing. They're watching the prices, they're watching the interest rates, they're watching all this stuff. And basically, the last I talked to her, she said that the beginning of next year, so January of 2023, is when they're pretty much planning on going balls out. And it sounds like, based on what you just said, that is absolutely not advisable. And are you saying that because of rates, prices, both? They're going to end up underwater potentially. What's your rationale there?
I just think the prices. I don't know how long it'll take for the cycle or for the interest rates and everything to cycle through to the prices. But I mean, I'm not looking for a house, but just from my knowledge of, like I said, following people that track housing, that do this type of stuff, it is already slowing down. I mean, people are pulling offers on houses, way higher percentage than they were in the past. I mean, it could be middle of next year that prices finally normalize. I mean, most people just kind of look at the payment amount, and that's all that they care about, right? What's my
Right.
monthly payment?
Yep.
But I think that prices are really going to come down. I mean, is it going to crash? I mean, is there a huge difference between a 6.3% mortgage payment on a $300,000 house versus if you wait 6 months and you get that house for 230,000 or 250,000? I mean, I don't know. To each their own. I just think that a lot of people get caught up in thinking that renting is pissing away money, and in reality, it's not necessarily that.
Thank you.
It's
Absolutely. No, and I don't just say that because I'm a property owner. I'm halfway being facetious, but no, on a serious note, I used to think that when I was a renter, that this is bullshit. Somebody else is cashing these checks, yada yada yada. But it provides a lot of benefits, and one of them was flexibility and essentially portability. I had the ability to say, you know what, I'm not going to renew this lease, and I am going to move, and I'm going to go to a different state or whatever. And no matter where life takes you or what you decide to do, you have a lot of options in the future. And it's not just pissing money away. And people that are on the home ownership side will say, well, you're just paying the landlord and you're not building any equity and you don't own anything. And if you're a renter for your lifetime, you're going to have rent payments forever, but your mortgage, principal and interest component will stop at some point. And there's some truth, I think, to both sides of that. But I certainly would say that renting has value for obviously both sides, the property owner, of course, but also for the tenant or the resident there, because it gives them choice, I think.
Yeah, absolutely. I mean, even if you can go month to month, especially, I mean, that gives you. I mean, yeah, it's paying more money, which doesn't seem to make sense. But if you're ultimately your goal is to have a house, then in the scenario that you gave, I would think that going month to month and then waiting on that opportunity whenever somebody out there eventually is going to really want to get rid of their house, and they're going to have to start dropping the prices. I mean, it just makes common sense. I think my house payment would probably be, you know, 50+% more than what it actually is due to the mortgage rates now. So something's got to give. The price is going to have to come down. And I think that, keeping flexibility, not needing or pressuring yourself to make it happen and waiting to find the right opportunity and then taking advantage of it is kind of what it's all about. But I just think that the housing market has a further turn coming to the downside as far as prices go.
Yeah, I think you could be right. And it sounds like in that scenario that, it would be, well, they might have to pay several $100s sort of in the interim to be able to live in one particular location, but also kind of hedging yourself, or not hedging yourself, but placing a bet that, to your point, housing prices may go down. So you may pay a few $100s more for a period of time to potentially save tens of thousands of dollars on a purchase later. Is that kind of the thought process there?
Yeah, I mean that's absolutely what I would think. Yeah, I mean it sucks paying it now, I guess, but I guess it's a minor setback for what could be, huge dollar savings in the future when you do ultimately make that purchase. But just the way the housing market is trending just does not look good to me. I'm glad I'm not selling, and quite frankly, another part of the whole housing process is I, I don't know if I mentioned on the last time I was on or not, but I took a home equity line of credit out on my house. And quite frankly, I'm guessing if I tried to do that today, I probably wouldn't be able to get as much money as I got back however many months ago that was, because my home's probably not worth as much as it was then. I mean, I guess it's all what the computer says, but it's just something to consider on that front.
Well, then you got
And
the variable rates too, which I guess we can get into at some point. I want to say one more thing before we move on, and I'm going to talk out of both sides of my mouth here. But for those that are renting, when I said that renting has value and renting gives you flexibility and all those sorts of things, which I think is true on the one hand. On the other hand, there are other people, they're probably yelling at their little phone right now listening to this podcast. Well, wait a minute. How the fuck do I have a choice if my landlord just jacked my rent and prices are through the roof and interest rates are up and I have no down payment because I'm paycheck to paycheck? How the hell do I have a choice but to do anything other than pay this increased rent amount and essentially be trapped in this place that I'm renting? So I think that would be the other side of it. And it sounds like, based on what we're talking about, that may be a somewhat temporary thing because, as you always like to remind me, at some point there might be some pressure on rents, and rents potentially could go down, even though generally they go up over long periods of time. And so that's the other side of the equation. Is it provides flexibility on the one hand, but on the other hand, some people in that situation would probably argue that they're trapped and they have no flexibility because of the market that we're in today. Any thoughts there?
I don't necessarily agree with that you're trapped into anything. You never are. I mean, I guess worst case scenarios, if you wanted to do in the scenario you gave, a longer rent or a 1 year, I mean, you can always break your lease and pay whatever it costs to do that, right? I mean,
Yeah, I guess you
but
could. I mean, there's different laws in different states in terms of recourse
yeah,
and stuff like that. But
I'm not a lawyer,
yeah,
but I mean, there's got to be a way, right? Or heck, if you wanted to pay less, just keep paying for the rental. If you happen to find a house, when you're 8 months into a 12-month period, I guess you got to pay 4 months rent. They'd probably, if you called the landlord and said, "Hey, we'll give you 2 months to get out of this lease," send them 2 months rent, and I'm sure they would gladly go ahead and try to get somebody in there to rent it again, so they'd be getting double rent for a couple months.
yeah. I mean, I know if it were up to me, and again, I would double check the legalities of this with my property management teams in the states that I'm in. But I would say that assuming that was all on the up and up, I probably would be open to it. It's funny. I actually have a lady who's moving out today in one of my houses, and she was a casino worker, and I'm not sure if she's still in that position or not. I would guess not, because she did several months ago qualify for rental assistance, and initially she was approved, I think it was for like 2 months, and they were like, do you want to take the rental assistance or not? And if you do take the rental assistance, then we can evict for a period of so many days. I don't know if it was 60 days or 90 days or something like that afterwards. So pretty much like they can try to game the system and say, all right, well, I'm going to apply for this rental assistance. I'm going to make you guys, or ask you guys to take it. And then if you do take it, then I'm going to basically stop paying and you can't evict me for a few months until I get on my feet. Well, luckily in her case, she got the rental assistance. The funny thing was that instead of getting the 2 months, they actually paid 3 months. And then she, for the first month that the assistance was supposed to cover her rent, somehow was able to come up with the money, and she paid cash. Not like cash like, dollar bills, y'all, but like, she paid her rent with her own money that next month, and then the rental assistance kicked in. Anyway, the reason I bring this up is that the property management company came to me and they said, hey, look, the market rent on this property is $9.95 a month. You're renting it right now for $9.25 a month. She's been a good resident. She pretty much always pays on time. She hit a rough patch. What do you want to do? And, it's like, well, do you raise the rent on somebody like that? Do you not raise the rent on somebody like that? And initially, I wanted her to sign a lease, and I was willing to keep it at $9.25 a month under market intentionally, assuming that she had the time to get back on her feet during this rental assistance period, right, where they're basically the housing authorities covering the rent for her to allow her to go back out and presumably find another job, because I don't think she would qualify for rental assistance if she was still at the casino. And anyway, so she ended up not wanting to do that. And so then it was like, all right, well, what do you want to do about this rental assistance? I'm like, well, let's just go ahead and take it. And basically she's moving out today. Today's September 16th. She's paid up through the end of the month. We're going to go ahead and turn it, and life goes on. And chances are when we remarket to a new tenant, I'm still waiting back on the rent comps, because at the time it was $9.95. Things change fairly quickly, even though not lightning fast like the stock market, with real estate. But rental demand does change, fairly quickly. I'm thinking they're probably going to come back to me and say, hey, it's $9.50. because I've looked at a couple other properties that are available, same Bed Bath count, same zip code, and they're about 10, one's 12 minutes away that they had listed on the site, and they were advertising them for $950. So we'll see what we get, but I don't know where I was going with that. My point being that not all property owners and landlords are bad people. I was willing to take somebody that even though I could easily probably jack the rent double-digit percentage, she was good. She was a consistent payer. We actually drove by the property maybe a year or so ago when we went out there and did a little tour and took a look at the different houses that we have. She had fucking like pink ribbons and bows and shit on not the windows, what do you call them, the shutters or whatever, And I'm like, oh, it seems like somebody that has some sort of pride of ownership, even though she doesn't actually own the home. I was willing as a property owner to not jack her rent, to not raise her rent. And some people would argue, well, you're losing money by doing that. But then you have to get into, well, do you want to have a turn where you got to pay thousands of dollars? Then you got to pay them to release it just to get an extra $50 a month or $100 a month or whatever the number is. I chose not to do that. So my point saying all that is you may have landlords out there, if you're a long-term tenant and you take good care of the place and you pay on time, that may not raise your rent at all, or it may not raise it as much as they otherwise would if it was a new tenant and a turnover. That's my song and dance on that.
Well, you know more about the real estate side than I do. I just kind of follow the real estate market as a whole, and that's kind of what it seems to be the experts are saying, and it makes total sense that with these interest rates going up, that people are going to be in a little bit of a bind. I guess something else that is fresh off the press, it actually just happened last night, that I found pretty interesting as far as kind of shifting back over to the markets, was FedEx has basically brought the entire market down today. Not to call out one single company, but it was kind of their whole news. They cut their guidance pretty large, and most people know what FedEx does. They ship shit around. They do e-commerce stuff. Not necessarily. I think they get $0 from Amazon anymore. But and actually their CEO was on with the great Jim Cramer last night. Who I listened to just to hear what he's blabbing about. But the CEO straight up said that we are going into a recession. So, if you think that you're smarter than the FedEx CEO, then so be it. But he's seeing that. I'm sure if you follow the news at all, you're seeing that every company out there, large companies, they're laying off employees, 10% of the workforce, 5%. And then people will come back and say, well, yeah, it's these tech companies are doing it because they had all this free money coming in. They were all getting fat and happy. But no, they're just the first ones to do it because they see what's coming. Not that I wish that anybody loses their job, but part of, raising the rates, slowing the economy down is going to be an increase in the unemployment rate. Inevitably, that's what we're going to see, in my opinion. But I thought that was interesting that FedEx CEO kind of came out and just said it. Hey, here's what we're seeing. And the people that are, shipping the goods and they know what's going on. That was kind of alarming for me to see. But, I think that the biggest thing as far as that's affecting what I have done in the markets this year, or the lack of what I've done in the markets, is just basically what the Federal Reserve is doing. I mean, more or less, they control the market, whether people like to admit it or not. They are raising rates, and then actually starting, I believe it was the beginning of this month, they're doing what they call QT, or quantitative tightening, is the fancy financial word to basically say they're pulling money out of the system, which is further reducing liquidity, which is further going to I would assume have a negative effect on the stock market.
So what do you said as it affects what you're doing with investing, without giving like specific, investment tickers or anything like that, because we don't give advice on the show, from a general standpoint or strategy, or even I guess in this case a tactical move, what are the types of things that you're doing? Are you saying that you're buying, you're not buying, you're moving out of certain things or not, or what? Ever think about starting your own podcast? I did too, and I had no idea how to do it. And then I found Buzzsprout. I use Budsprout for this podcast here at Real Talk Personal Finance. It's pretty badass. You can start with pretty much any equipment that you may already have. And if you're like me and you had no clue what to buy, they got a guide that will get you started with some very basic equipment. You'll get a great looking podcast, some audio players that you can drop into other websites if you want to, detailed analytics, which is how I know how many countries and counting we have listening to the show, so you can see how other people are listening to it, tools to promote your episodes, and more. Podcasting isn't all that hard when you have the right partners, and the team at Budsprout is passionate about helping you succeed. Join over 100,000 podcasters already using Budsprout to get their message out to the world. If you want to give it a shot, feel free to use the affiliate link in the show notes. And as a token of appreciation for doing so, you will receive a $20 Amazon gift card after your second paid membership month. So check it out. And now back to the show.
I am not buying. I don't really sell stocks all that much, especially in taxable accounts that we discussed last time. Probably towards the end of the year, I will, just so I can have a little tax loss for my tax return, because everything that I own has gone down.
Yeah, how's that shit coin?
Hey, I'm holding on. It's doing just as bad as everything else, maybe a little bit worse.
Oh no, those rent checks are still coming in. They might be a little bit late, but they're coming in.
Yeah, so one thing that I guess the lack of investment part is I am 90 to 95% certain I am contributing. Well, I'm 100% certain I'm contributing to my 401k. I don't think I have invested a single dime in my 401k this year that I've put into it. Basically, I'm putting it in there, getting a tax break, and the holdings that I already had in there, I'm holding on to those, and I'm down probably 50%. Just absolutely getting crushed. But the other money that I'm putting in, it is just, going in, sitting there in cash, more or less.
All right, I can't help myself because you've thrown the softball that, like, I just might want to try to hit a grand slam, and this isn't anything against you, but I have to ask this, okay? Because you've said in past times something to the effect of, I buy, own, and hold the best companies in the world, yada, 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 and I'm going to hold them for decades. Most people, myself included, would hear that and then just look at the situation, look at the market, look at everything else, and say, if he truly believes that, then why would he not be plowing every penny reasonably possible, including his 401k contributions, into those same allocations with that type of belief and conviction? Like, wouldn't this be the optimal time to put new money to work, even if it's potentially going to go lower in a little bit? Like, you don't know that. Essentially, what it sounds like you're describing is some form of market timing. Am I wrong?
Yes, you're wrong. I'm not doing market timing. I'm not going to try to time the bottom. The Fed has told us what they're going to do. It's just a matter of the market believing it. Now, if we get back down towards those June lows again, will I start deploying some money? Probably. I mean, that's another 8 to 10%, which, I mean, in the grand scheme of things, isn't a huge amount. But I mean, there's prognosticators out there saying that 3,000 on the S&P, which is another, what is that? I believe that would be another 20% drop roughly. Is definitely possible. And it's more of, I wouldn't call it market timing. It's just, I'm not in a hurry to invest the cash. I don't think there's any rush to be in it. I'm guessing there's people out there that when we've had these huge rips, they're like, oh shit, I'm missing out. And they started investing then after the markets, had a bear market rally of 8%, they start investing, then boom, the rug gets pulled on them again and they lose that money again. Right now, I'm just kind of tactically sitting on the sidelines, I would say, and just watching what plays out. Yeah, could I miss the first 5 or 10% to the upside? I mean, yeah, it's possible, I guess. But to me, the risk is all to the downside right now because of what the Fed is doing.
Yeah, maybe it is, but I'm a little speechless. I'm very, very surprised because we used to. I won't name names, but there was a gentleman that we both know that we used to brag about putting money in his 401k, and he would put it in his cash, and he was trading the VIX in this other account, and then all of a sudden he wants to put it in, and we used to rag on him a little bit because that's exactly what it is, though. It is. I mean, it's market timing. It may not be like a day trading type of thing, but pretty much you're making a bet that the market's going to go down, and you're going to be able to catch it when it's lower, and you just acknowledge that maybe you get it wrong a little bit, but because of all this external signaling by the Fed and what's going on with everything else, that you're willing to, I don't want to say take that risk, but make that move. And that just, I don't know. It's crazy.
Well, it would have been better, I guess, if I sold out of all my other positions. I mean, it's not like I'm,
No,
I
no.
don't know what is, I don't know what, percentage of my 401k is actually in cash. That's been my contributions this year or whatever. But, I honestly, I haven't sold anything
Well,
that
that's
I
good.
owned. I don't think I haven't sold anything in my 401k. I don't think I've sold anything in my IRAs. One strategy that I am using, because I can in my IRAs, is an option strategy called covered calls. I know I texted you and said get your covered calls on, because every
Yeah.
time the market goes up, I start writing them so that when I inevitably lose my ass when it goes back down, at least I make something. And
Yeah, but
actually,
you're
right
doing that in a
before I was,
retirement account, though. Like sorry, I didn't mean to interrupt you. Go ahead.
yeah. Oh, I was just gonna say, shortly before I got on here, my wife actually sent me a text and said, "I got an email that I have an expiring options position." I don't know what the hell that means, and I said, "Oh yeah, I know that you do," because
Oh my God.
that's because I've been writing cover calls on our IRA account.
All right, so a couple things is for the sake of the listeners, because we're kind of, I mean, this is part of the show, but we're kind of going off a little bit here. The IRA, individual retirement account, if you've listened to the show for any length of time, you probably are familiar, or at least somewhat familiar with different types of accounts. Anything you do within that account, at least from an immediate perspective, from a tax standpoint, there's no tax impact, right? You can buy and sell all day and make a bunch of money, lose a bunch of money. I mean, for the most part, doesn't really matter. The covered call thing that you had mentioned to me, strategy for me in the account that you were alluding to when you sent it to me, was in a taxable account. And so what I would end up doing in that case, two things, and this is why I didn't do it. Number one, I would be generating income in that account, which would be taxable at short-term gains or ordinary income rates. And number two, the options contracts that I could write at the time, right, if I'm going to sell calls or whatever at the time, then even if they got exercised, I would still lose money because I was down so much in the stock anyway, which is why, folks, you don't buy individual stocks unless you really know what you're doing. But anyway, so that's just for FYI for you. That's why I didn't do it. And for the listeners, there's different types of accounts that you can do different types of strategies or investing in, and they have different tax implications depending on which type of account we're talking about. So hopefully that sheds a little bit of light on what we're covering here. So anyway, all right, yeah. So you told me to do it. I didn't do it. I don't regret that at all. By the way, that and we're not going to say the name of it, but that particular stock has been, for the most part, going up. I know it's down today, but it's been going up, and that account's doing very well. And had I done that, those shares would have got called away from me. I would have collected a little bit of premium, taxable to my face. I would have sold at a loss and locked that in and given it to some other asshole that held onto the stock and watched it go up. And I would have been like, man, I'm really not happy about doing that. So anyway.
Or you would have got called out of it and saved yourself from a shit ton of losses in the future.
No. If I had more money, I'd back up the truck at some point, especially if what you're saying comes to fruition. But that's a story for another day. All right. What else you got?
Yeah, I guess kind of the other thing that I'm doing, and I know in other podcasts that I've been on here with you, I pretty much hate cash. I don't like having cash whatsoever. But I my cash position has increased. I'm not thrilled with it. I know it's sitting there losing money, but I have begun to use that cash, and something that I would suggest that everybody does, to pay off, I guess, floating rate debt. I have a
Yes.
margin loan on an account that increases every time the wonderful Fed increases rates. My interest rate goes up, so paying that off is kind of been, I guess, my investment. I've been investing very little this year, not necessarily due to market timing. It's just I don't think I'm going to miss out on anything. The market's going nowhere for a while, except for maybe down.
Yeah, there was a guy who said, I was reading another article. I don't know if it was Ron Insana on CNBC or somebody else said something about, and I don't normally get caught up in this, but I knew we were doing the show. I'm like, let me click on a few headlines and read some bullshit so we got something to talk about. And I swear, I think it was one of those articles that said, like, there's a lot of people that believe that the markets will be flat for the next decade. I'm not sure I believe that, but that's been said a time or two out there.
Yeah, I mean, I don't know if I necessarily believe that. I just don't think it's going to go up a lot anytime soon. Maybe once the Fed decides, oh shit, we've raised rates and now we're in a recession, and then they do what they call the Fed pivot and they start either lowering rates or something like that. Then that's when you're going to see the market more than likely take off. I'm not going to try to time that. I'm just kind of sitting on the sidelines, just keeping cash and waiting for whatever it is Warren Buffett called it, the fat pitch, to come through, because I don't think that it's happened yet. And I think that, will I invest at the bottom? Absolutely not. Back similar to what happened with the COVID crash, it all kind of happened pretty quickly, though. It was, you buy low, you buy lower, you buy lower. And then eventually maybe it'll go up. That's kind of, I guess, my theory on that. But so I've been kind of focused on paying down some debt that I have that isn't the most advantageous in this current economy, as far as with rates going up. My margin loan goes up pretty quick. My HELOC doesn't go up as fast, but at some point, if they continue to raise rates, it may even I guess make me a little more comfortable to start paying that off as well.
So for the listeners' sake, tell them, elaborate, like the average person listening to this show, what types of debt might they have in addition to what you mentioned that could be variable or floating that they might want to take a look at?
Well, the worst of the worst would be credit cards. um, I'm sure that rates on those, I don't know, I've never carried a balance on one, but I'm sure that the rates on those are going up pretty much in lockstep with the Fed increasing interest rates. I guess, I mean, you could have a variable rate mortgage on your house. In that case, I don't know what to tell you, really. It just depends on where your rate's at right now. Hopefully, you just locked it into a fixed rate about 18 months ago when rates were super low. If not, then you're comfortable with what your payment would be at a fixed rate. It might not be a terrible idea to do that, but I think at this point the Fed is hopefully closer to done hiking rates than in the middle of it. But it's just something that you want to keep an eye on if you're in that situation, to make sure you're aware of what's going on out there with the rates. So you could have that as well. Trying to think, my HELOC does have a variable rate as well. I don't even know how often it goes up. I believe it's once every 6 months, because the last time I got a letter in the mail that said that my rate had increased.
I think it's a quarterly reset. I could be wrong, because I know the product. I know the product you're talking about. I used to have one at the same place. Yeah, I think it is a quarterly reset. But theirs is actually pretty good. There's a whole bunch of different ones out there. I remember when I was first looking, some of the rates I was quoted for some of the larger institutions was crap. And we won't name the facility, but it's a credit union that we're both referring to that I used to have a HELOC with, and Cube Crusher still has one with them. And they got a pretty cool feature on theirs. It's there's a fixed component if you want to lock. There's most of the line is variable unless and until you lock, and I think it was like prime minus 49 bips or prime minus 51 bips. Basically, prime minus 0.5% was what the rate is, and there's certain caps in there too. So,
but yeah, I would just make sure that I'm aware of any debt that I have. If you don't know what the hell is going on with it, I'd probably try to find some paperwork on it or call whatever company it is to see if that rate is fixed or if it can change, because you don't ever want to get caught off sides with that. And as fast as they've been hiking rates, those interest rates are probably increasing pretty quickly, even though they're still not giving you shit on your bank account. Trust me, their interest rates are going up.
Yeah, some of them. I mean, the deposit products, they're always typically slower to catch up, and the loan type products are usually pretty quick to change. But I've noticed even some of the online quote unquote high yield accounts that have been out there for a while, they are pretty frequently, actually I'd say every couple of weeks it seems, raising their rates a little bit. So there's that. You did mention something I wanted to just bring up really quick about variable rate mortgages. And there was, I don't remember if it was a podcast I was listening to or something I was reading, but there are some people out there that are making arguments now for getting, if you can, an adjustable rate mortgage. And we're not telling anybody what to do that, not do that. But the argument was the average person stays in a property, I think it was for right around 7 years or even fewer than that. And so these people are getting these, 30-year fixed interest rate mortgages, or in some cases 15-year fixed interest rate mortgages, and they're basically potentially paying more even though they're not going to actually be in the property for that length of time, whereas they could get an adjustable rate, which is going to have a lower rate for the first however many years, depending on how your adjustable rate mortgage or your ARM is structured. And by the time they are getting ready to go up, that person is likely to have sold that property, moved out of that property, or whatever. And depending on the interest rate environment at the time, if they did want to hold it longer, assuming rates are lower, and in this case they may not be, but if they were, they always had the option to refinance. And then sort of their backdrop to that was, well, you can run the numbers, you have an idea hopefully of how long you may want to stay in the property or hold the property, and then even if rates adjusted upwards on you, there's going to be some sort of a cap, there's going to be some sort of a ceiling where, similar to the HELOC, it cannot increase, or most of them can't, by more than a certain percentage over a certain frequency, and no matter what, there's going to be an absolute cap. And so if you did the math with that in mind, and there's some calculators out there that you can run scenarios where you say, okay, well, what if it goes up by 0.5% or 2% or whatever the number is over this period of time? What does that look like versus, and do a side-by-side, the fixed rate? And some people, I know somebody that was looking at some rental stuff that was trying to make that decision, and I was actually kind of surprised that their lender was trying to get them to go with an adjustable rate at first. And we looked at it and we did the calculator, and the numbers are probably a little bit closer than you might expect them to be when you're really looking at something like that. I know the lender that I use, they are not doing any sort of investor loans that are adjustable rates. So you got to shop around, see what makes sense for your situation, run the numbers, and in the words of one of the real estate people out there, he always says, do the math and the math will tell you what to do, right? Got to give kudos to Russell Gray from the Real Estate Guys for that one. There's another great podcast. If you haven't, I don't like to plug other shows, but if you haven't checked him out, check out the Real Estate Guys radio show. They've been around forever. Really cool guys. And Russell Gray is their financial strategist, and I give him a lot of credit for what they're doing over there. But anyway, all right, so I just had a comment on the variable rate mortgages. Any final thoughts on that?
Yeah, I mean, like you just said, I think you just have to do the math on it and do whatever you're comfortable with. There's no necessarily right or wrong answer, but and there's always options in the future too to get out of it with a refinance or something like that. I'm all about having options, I guess, with anything that you're doing.
Yeah. No, I do agree about the floating rate debt, though. Like, I had a margin loan myself, and I killed that. And actually, you would be proud. Ran my cash position down lower than I'd like to, but still have, for what we need, adequate cash at the moment. I was trying to improve that a little bit, but that was something that I was not willing to. It was almost a mental thing. Like, the size of the loan, the dollar amount of the loan was really not that much relative to like how much I have out in mortgages, But because it's something that, I would check the account or log into the account, usually maybe every day, every couple of days, I would see it. It was in my face all the time, and the interest-only loan and the margin loan, you have to pay the interest every month. So I would see that coming out every month. Whereas with the mortgages, essentially that's all outsourced to the tenants anyway. And yeah, you could say, well, if you had that $1, you probably would have been better off prepaying one of those mortgages or something like that. You can make that argument. But sometimes it really is about the psychology and emotional part of money and personal finance that drives us to make decisions. And I've become more and more self-aware of that, and sometimes it's like, well, how would I advise a client if they came to me with this situation or that situation? And sometimes when I kind of get stuck, I have to really ask myself that question and try to come at it from an objective point of view, which isn't always easy to do. But anyway, anything that's variable, that has an interest rate that can and likely will continue to increase on you, I think what Cube Crusher is saying, and I fully agree, you may want to take a serious look at whittling that down to the extent that you can, depending on what it is, because it's likely to continue to go up on you, and your interest expense is only going to increase.
Yep, I agree with that. And I guess kind of a final word on everything that I've rambled on and where I think the market's going and what I think that's happening is that right now and the current situation is a time for caution. I think is the best word that I can think of to use with it. Um, if you want to profit off of it by doing things that let you go short or bet against the market, or to protect your long positions by going short against the market, that's fine. But I'm very cautious. I'm not going to fight what the Fed's telling me they're going to do. They're pulling money out of the system. Liquidity is going low. Interest rates are going up. Companies are laying people off. You got, FedEx CEO telling you that he thinks a recession's coming. We got a war that's still going on in Europe. It sounds like the whole country of Europe could be having an electricity crisis over there, which, does have an effect here in America on us, as well as, on top of that, you got the dollar that's probably the strongest that it's ever been, which is good if you want to travel over to Europe. So maybe Travel Queen can come on and talk about how much cheaper it is to go to Europe now because the dollar is super strong. But also at the same time, that strong dollar also hurts company earnings. And when company earnings go down, the stock market goes down. It's not rocket science to figure that out. So, I'm being cautious myself. I'm not selling out of positions, but I'm trying to position myself as well as I can to, I guess, be able to take advantage whenever things change. Plus, at the same time, not fully lose my ass while we're in this moment right now, because I'm not a doomsday type of person. I generally think 5 to 10 years from now, will the market be higher than it is now? I mean, the odds say yes if you look at history. But am I in a hurry to throw all my money in the market right now, knowing everything that's currently out there? I don't think so. And you could come back and say, oh well, don't they say to be greedy when others are fearful? Yeah, that's some saying that's out there. I wouldn't necessarily say that I'm fearful of anything. I just don't think there's that much money to be made right now in this market, and it's a time to, I guess, reduce your balance sheet while the Fed is reducing their balance sheet.
Reduce your balance sheet?
Right, as far as lower your debt.
Okay, your liability side of your balance sheet.
Right.
Okay,
Yeah.
okay.
Right. Yeah. Yeah. You don't ever want to lower your assets. They're doing my accounts are doing that for me well enough.
Yeah. Well, so a couple things I was taking notes as you're talking. The first one is you said there's probably not much money to be made, and therefore you're approaching this the way that you are. My first question would be, if your allocations were different going into this, in other words, if they were more conservative or not as aggressive, do you think that you would be doing anything different now? Would that change anything?
No, I don't think it would change anything at all. I mean, for most people, I'm still invested very aggressively. For me, it's I'm not invested nearly as aggressive as I was. I do have more cash, but no, I don't think that it would change anything if I was more conservative before. Then I would still be kind of doing the same thing that I'm doing right now.
Okay, well, that's a good sign because there's a lot of people that would answer that question differently, so that's good. The next thing I had on here was, and you're going to laugh when I say this, but since growth investing, at least from the stock market standpoint, seems like it could be on a little bit of a slowdown or a lot of bit of a slowdown, will you consider any sort of cash flow investing?
I guess the cash flow investing that I do is trading futures, which is a whole nother thing, and I do get pretty good cash flow from that. But as far as changing anything, buying dividend stocks, that's not going to happen. I don't plan on doing that.
Real estate, not even necessarily rentals, although that could be part of it, but anything real estate related. Like, we talk and joke sometimes about the value add stuff and the syndications, and I like syndications. We had a whole real estate mini series. We did a couple shows on syndications. O-Dog was on here talking about syndications. And it doesn't seem like that's your cup of tea. But now that things have changed there as far as the stock market stuff goes, and you think that, the opportunities aren't maybe as great as they once were, at least at the moment, but there's still things like self-storage, for example, out there where these operators are adding tremendous value because they're buying these mom and pop locations that some of them don't even have a fucking website, and a lot of them haven't raised the rent since decades ago, and they're going in, they're improving them, they're forcing the value, they're forcing the appreciation, they're giving a little bit of cash flow along the way, hopefully with signs of a big exit. Of course, they're still subject to a lot of the same economic factors, but would you ever consider something like that versus putting additional dollars to work in the stock market in a time like this? Or do you think it's just still not for you?
No, I still don't think it's really for me. I think that, investments like that, they can perform well or, perform similar to the stock market. I think the reason that people get better performance out of those is because you don't have to log into your account and see you've lost, five figures in a day and stuff. There's no account balance that's ever shown to you if you're in, some type of private placement or something like that. Could the value be going down? Oh, hell yeah, it could be going down. And you would, you don't really ever know that. You don't see that. So I think as far as the psychology part that you mentioned before, yeah, I think that plays a role in that type of investing. But I guess I'm not interested in that because I know that with my holdings, even though I'm down whatever 50% in my 401k this year, I don't care. I'm not going to sell out of them because I'm down 50%. Like it doesn't phase me, I guess. If you're somebody that would, then maybe you would like those other types of investments more because you wouldn't have to log in and look and see, oh God, I'm down 50% and then freak out and sell.
Yeah, that's what a lot of people end up doing.
But
I still think you're crazy to not put the money to work while you're down 50%, but we'll table that. All right, a couple final questions for you. For the sake of the listeners here, for somebody that, let's say they're in different phases. So we'll take three individuals. We'll take the first person that's 22 years old, fresh out of school, got their first big boy or big girl job. You got the second person that's, say, mid-40s, mid-career. And then the final person that maybe is early 60s, approaching retirement. And I'm not going to use the word advice, what suggestions might you have for how they should be thinking about what could be unfolding here in the relatively near future? What would you say to those three people?
I mean, I would think that the young person, assuming that they're starting their career, obviously they want to put money into their 401k. Now, more than likely, they're not into investments like I am. If they are, more power to them. I would do the same thing that I'm doing since I'm fairly young. If not, obviously they want to be investing in that. I would tell them that they could be in a good position. Like I mentioned before with the housing market, if they're looking to buy a house, they're 22 and they want to own a house by, they have a goal that by 25, they want to own a house, probably the closer they get to 25, the better deals they're going to see on houses because I think that, it's obvious by what the Fed's doing, they want the housing market to slow down. Somebody in their 40s or 50s, they're probably not feeling real good right now because the 60-40 portfolio, we didn't really talk about bonds because bonds are boring as hell, but they're getting crushed this year too because rates go up, bonds go down. Yep. So they're probably not real happy right now, but I would say probably close to similar things like we talked about. If they have any debt still that's not fixed, to try to wipe that out a little bit because that'll give them a little bit more cushion theoretically if they're retiring in 15 years. The less debt you have, the less payments you're going to have, the less expenses you're going to have, and ultimately, less money you're going to need or be spending at that point. But yeah, I think they've got a little bit of a rude awakening that's hit them, but I wouldn't slow down my investing. And if you're in your 60s, assuming that you are retired at this point, you're probably losing your ass too. But hopefully you have, other sources of income, possibly Social Security, if you've hit 65 or something like that, that can kind of keep you afloat. the biggest thing that I would tell, the older people to do is don't freak out and start selling all your shit, or you're going to get burnt pretty bad whenever the market does inevitably go up. So kind of hopefully they got a good plan, a good financial planner, and I would say, stick to it regardless of what's happening, even though I think that, we could be in a prolonged period here of slow growth or no growth or market going down, whatever you want to call it. Just stick with what you're doing.
Even though your strategy has changed and you're deviating from your original plan.
Right. Well, I mean, these people, presumably these people don't follow the stock market at all. I mean, I'm not trading every day. I'm following everything pretty closely. At the drop of a hat, I could go in and invest every single dollar of cash that I have in my 401k, in my IRAs, in my brokerage account. I could take cash out of my bank account and do my IRA contributions and invest it instantly. I mean, it could all change in a day if there was a huge washout in the market. I've just positioned myself to be able to do that.
Gotcha. Okay. Is there a light at the end of the tunnel?
Well, there's always a light at the end of the tunnel. Like I said, I'm not a doomsday person. I'm just listening to what the Fed is telling me, and what they're telling me right now is they're not letting the horse run too fast. It has been for years and years and years, and then COVID happened, and they started handing out more free money, and now they've realized, oh shit, everything costs everybody a whole lot of money. And as long as they're in that position, I'm just of the belief that there's no rush to go out there and throw your money into risk assets when it's a total risk off environment.
So if someone's listening to this and they're like, man, we're over an hour here. We've listened to Cashflow King talk about rental assistance and possible eviction, and Cube Crushers talking about this, that, and the other thing. And the title of the show is Why We're All Fucked. If you had to sum that up based on this conversation so far, including anything maybe we haven't said or talked about, and they're like, all right, guys, like, why? I still don't get it. Why? What would you say to the listener?
That's a good question. I would say it is because the economy has been too good for too long, and it's time. Everything works in cycles, and another cycle started when the Federal Reserve began hiking rates from zero. And they've had two of the largest hikes in Federal Reserve history, and they're about to do another one next week. That is why you're going to see housing prices go down. That's why you're going to see mortgage rates go up. That's why you're going to see the stock market go down. That's why Bitcoin's going down, even though some people, the big Bitcoin believers, say it's a hedge against inflation. It doesn't really seem to be. That's not why I invested in it. That is the reason why when there's less liquidity in the system, there's less money moving around, there's less capital available to companies, people lose jobs, bad things happen.
That's fair. Okay. Any final comments? Anything else that we didn't hit today? Anything you want to say to the listeners, or are we about wrapped?
Nope.
Check the mic and make sure it sound right, boys.
Cube Crusher joining us for episode 28 of Why We're All Fucked. Thanks again to everybody for listening to the show. Shout out again to our 17th country and counting listening to the show. We really appreciate it. If you did like today's show, feel free to go back to episode 15. Fuck boys. Forward. But hopefully you got some value out of today's show. Hopefully you guys enjoyed it. I think we did. And I'm sure we'll have Cube on again in the future about whatever topic we decide we want to talk about at that time. You did mention Travel Queen, and I got to stop mentioning her because she's driving me crazy. She's out in California right now, but it's one thing after the next with her. She says she's coming back on the show. I'm starting to not believe it, but I don't know. We'll see. And then I do have the other guest I mentioned. His family's doing better. He was actually out, I believe it was in D.C. with one of his kids. I think he's still out of town. I'm not sure if he's back this weekend or not. But anyway, hopefully we get him on the show. No promises. We're doing our best. But anyway, thanks again for listening to the show. Episode 28, Why We're All Fucked, featuring Cube Crusher. We will see you in the next episode.